This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks. I'm John Budden, and welcome to Money Talk. Here's the lineup for today's show. We start with Dave Sally of the Ottawa Business Journal, then to an excerpt from John Embry's talk at the Precious Metals Forum here in Ottawa on October the 5th, and on to Ken Cordes, who is chairman of Starfort Investment Holdings and a new member of Bill Morneau's Economic Advisory Council. After the news, to a two-part interview with David Prince, who is the founder of Harbinger Capital Markets Research, and we conclude today's show with an excerpt from Eric Sprott's presentation to the Precious Metals Forum of October the 5th. But first, let's go to Dave Sally of the Ottawa Business Journal. I'm joined by Dave Sally of the Ottawa Business Journal, and it's time for the weekly update. Now, Dave, a senior federal government bureaucrat didn't mince words this past week when it came to criticizing the Fed's much ballyhooed Workplace 2.0 program, while beleaguered networking firm DragonWave bounced back with a big contract win, and a group of Chinese billionaires stopped in Ottawa as part of their cross-country scouting tour for investments.
That's right, John. Well, let's start with some strong words from a senior government bureaucrat about the Fed's plan to reorganize office space. Kevin Radford is an assistant deputy minister at Public Services and Procurement Canada, and during a presentation at Wednesday's Ottawa Real Estate Forum, Mr. Radford called the federal government's Workplace 2.0 office modernization program, quote, a disaster, unquote. Now, the Workplace 2.0 program was introduced in 2011 with the goal of encouraging more collaboration between employees while allowing greater work flexibility and making better use of technology such as video conferencing. But Mr. Radford, the federal government's top real estate executive, said the program put too much emphasis on reducing the government's real estate footprint and failed to properly integrate new technology into the revamped workplaces. He said basic requirements such as secure access to Wi-Fi have been overlooked in many of the new offices, making it hard for workers to communicate by email, for example. Mr. Radford also told the audience he'd like to see federal office hubs scattered throughout the National Capital Region so employees could work closer to home if they so chose. He also questioned whether the Fed should own so many office buildings, especially given the challenges in accurately predicting future demand. Government figures show that slightly more than half of government space in the National Capital Region is owned by the Crown rather than leased. Much of that inventory is old and in poor condition. Bernie Myers is Vice President for Eastern Canada at Morguard, one of the federal government's largest local landlords. During a panel discussion on Wednesday, he said he was thrilled at the idea of the Feds leasing more space in the capital.
In other news, things appear to be looking up for Ottawa tech firm DragonWave.
Well, John, after announcing earlier this month that the company lost $3.7 million U.S. in the second quarter of its fiscal 2017 year, DragonWave executives had a reason to smile this past week. The company's stock price more than doubled in value on the NASDAQ Thursday, hours after it announced major U.S. carrier Sprint will be using the company's technology to help densify its wireless network. DragonWave, which also trades on the TSX, ended Thursday up 94% on the NASDAQ at $4.29. The company saw its share price plunge earlier this month after it reported the drastic decline in second quarter revenues. That earnings report also marked 6 straight years without a quarterly profit for DragonWave. However, Desjardins Capital Markets analyst Mahar Yagi was quoted by the Financial Post as saying the Sprint deal could mark a turnaround for the Ottawa networking equipment company.
And finally, some Chinese investors with deep pockets were in Ottawa this past week scouting out potential business partners.
That's right, John. Delegates from the China Entrepreneur Club were in town on Tuesday to meet with local business leaders and eye potential investment opportunities. The group consists of 31 of the Asian countries' leading entrepreneurs, diplomats, and economists, and its members collectively bring in about $460 billion in annual revenues. They stopped in Ottawa as part of a cross-country tour to seek out potential business opportunities here. Local presenters included Spartan Bioscience founder and CEO Paul Lem and Elspark's Leo Lax, who said Ottawa companies are creating new innovations on a daily basis. Mr. Lem pitched directly to the Chinese crowd, suggesting his company's DNA diagnostic technology could pave the way to eliminating deaths from diseases such as stomach cancer in China. Blair Padiker was Invest Ottawa's host for the event. He said the nation's capital could be a very attractive place for Chinese companies to do business because of its wealth of high-tech talent.
And Dave, what's coming up on the OBJ's radar this week?
Well, John, TICON, an event that bills itself as Canada's flagship conference for entrepreneurs, SMEs, and investors, is coming to Canada's Brook Street Hotel early next month on November 3rd and 4th. Speakers include Code Cubit of Mistral Venture Partners and Richard White, the CEO of software company Kabuto Solutions. The event will also feature a pitch fest from some of the country's most promising startups. For more information and to register, go to TICON Canada, that's TIECON Canada 2016.ca.
Dave, thanks for a great update, and have a good week, and we'll talk same time, 2 p.m. next Sunday.
Well, thanks a lot, John. Great talking to you.
Now to John Embry, the renowned senior strategist at Sprott Asset Management.
Now, at this point, some of you may be wondering that given the unprecedented money creation and debt growth globally in the last few years, why has gold fallen so precipitously in price recently? Logic says it shouldn't have, because it represents the antithesis of paper money, which is undergoing serious central bank-driven debasement. Now, to be fair, even though staggering quantities of high-powered money have been created at the central bank level, the velocity of that money has virtually collapsed, which goes a long way to explaining the weak global economy and the absence of virulent inflation to date. However, that virulent inflation is on the way. However, when people fully grasp what's happening to their paper money, they will try to get rid of it, the velocity will pick up, and then you will see inflation mount very quickly. In addition, why gold has done poorly, the technicians amongst us felt that the dramatic price move from $252 per ounce from the bottom in 2000 to $1,900 in September 2011 had to undergo a significant correction. And as luck would have it, a perfect 50% correction of that advance was achieved when gold bottomed within the last year at $1,050 per ounce. However, there has been another important factor which gets considerably less attention, and that is the subject of so-called paper gold. This consists of futures trading on the COMEX in America, the massive transactions in unallocated gold in the LBMA in London, a proliferation of ETFs, pooled gold accounts, unallocated accounts in the Western banking system, etc. This has essentially permitted the unrestrained selling of various paper gold products with little or no physical gold backing. Even system apologists like Jeff Christian of CPM Group admit there may be as many as 100 paper claims in every available physical ounce in the Western system. Others actually believe the number may be as high as 300 paper claims. Well, it doesn't make any difference. I would suggest that this has been a classic Ponzi scheme which will be revealed for all to see when the Western world finally runs out of physical bullion. Nevertheless, what it has done is provide a wonderful opportunity to buy whatever physical gold is still available at a bargain price.
If you'd like to listen to John Embry's complete presentation, go to my website, johnbudden.com. Coming up, we have Ken Cordes, who is chairman at Starford Investment Holdings and a former vice chairman at Goldman Sachs Asia. And he joins our affiliate BNN to discuss Bill Morneau's Economic Advisory Council and why it's time to be aggressive in our policies to grow the Canadian economy. Stay with us, folks. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
All right, a final push to clear hurdles confronting a Canada-EU trade pact has failed. Our Trade Minister Freeland has announced that the failure of the talks with Wallonia on an EU-Canada free trade deal. The minister walked out on the meetings in Brussels this morning. For his perspective on this, we are now joined by Ken Curtis. He is the chairman at Starford Investment. He is also the former vice chair at Goldman Sachs Asia. Ken, very nice to see you again. Thank you.
Thank you.
Quite a bit to discuss today, but first let me get your take in terms of CETA and these failed trade talks. Do you think that they will fail, or will they be salvaged here?
I think they'll work to try to come back to negotiations in a few weeks. EU has 27 countries that have to agree, and some countries are federal systems. And so even the regions have to agree, and that's what's happened here. One region is still holding out. They only got the full trade text 15 days ago. And so they're saying, look, you negotiated this for 7 years. We aren't going to rush it through in 15 days, and we have some issues we want to look at. And so I think there'll be just huge pressure put on them. There'll be some incentives given to them by Brussels, and I think eventually the Wellens will come on board.
Does it set any kind of precedent, though, for further difficulties with other countries getting trade deals done?
Well, I think Brexit's is the big issue coming up, and I think this is going to be extremely difficult. Both because the Brits don't really have a view on where they completely want to go, and then coordinating 27 countries, and the Brits, you know, are experts at dividing people. So this is going to be a very complex negotiation.
But you do think that Canada should be hopeful that this will actually get passed?
I think Canada should be realistic, not give up. We're almost there.
Okay. Let me shift the topic here a little bit as well, Ken, with respect to you being part of Finance Minister Bill Morneau's economic advisory council, and the big decisions yesterday on the infrastructure bank, increasing immigration and increasing foreign investment. Let's talk about this infrastructure bank and really why this couldn't have been done earlier to start.
Let's set the context. The Canadian economy is not growing as fast, and the outlook for the next several years is slower growth rather than faster growth. The G7 economies look like they're going to have a difficult, slow period still for some time into the future. Our productivity is weak and declining. The demographics in the country aren't great. So if you think out 20 years, 30 years, the proportion of people retired relative to people working is going to get bigger and bigger. So now's the time to make some big decisions. Why the previous government didn't make decisions, I can't speak for them, but they should have. And at the same time, I think we're in a unique situation because there's just so much money available in the world. These policies of quantitative easing have meant, and slow growth and almost deflation in some countries, has meant that interest rates are ultra low. There are $14 trillion today of government bonds yielding less than 0% negative yields. There's about $39 trillion of government bonds out there with less than 1% yield. So if we could tap into that and bring some of that money to invest in our infrastructure, to upgrade the infrastructure and then prepare the infrastructure for the next 20 years, that would provide growth, short-term, long-term, and mid-term to the economy. It would increase our productivity level if it's done right. So there's a lot of pluses with that. You always want to borrow money when it's almost free, right? And if we can borrow that money and increase the growth trajectory of the economy, then that's a win-win-win for everybody in the country. So I think that's sort of the background of what we're looking at. And then you have to look at how big is the infrastructure gap.
Right.
There are all kinds of estimates. It shouldn't take people an hour and a half to get to work in Toronto. It shouldn't take people in Vancouver sometimes 2 hours to get to work. We just haven't invested enough in infrastructure, urban infrastructure in Montreal, Toronto, Vancouver. Should we have broadband, 5G broadband to every house in the country? Should we have, like the University of Calgary is proposing, a corridor for our pipelines and energy across the northern part of the country? So they're big ideas, and my sense is that we're at a moment like the country probably was when we decided to build the national railways.
That's what you liken this to.
It's that scale.
Okay.
And this changes the future of the country. And I think the objective in doing that is, over the next 15 years, to increase on average income per family by about $1,000 a year for 15 years. And that's a big ask, but I think we have to be bold. I think we have to be courageous. And I think the moment to do that is now.
And the infrastructure bank the idea is to have it as sizable as $200 billion. Is that big enough for what you just described?
I think that's an initial cut. My view is that you have to either be big or go home. If the gap is $500 to $1 trillion, and I think it's more on the upper side than the lower side, $200 billion isn't going to be enough. $200 billion over 10 years is 1% of GDP, $20 billion a year. Yeah, it'll make some difference, but I think we can, over time, we'll have to do more. We can be more ambitious and run this as a bank. We could, the governments, federal, provincial, municipal, they all have a big interest in this. They could be part of the capital, and then we could lever it up by issuing 20, 30, 40, 50-year bonds against this infrastructure.
I think some of the people I've spoken with over the past 24 hours, and like anything in business, it's all about implementation. It is about strategy, but it's about implementation and who's going to be running it. And the feedback I've been getting, of course, is that it should be somebody in the private sector, somebody that really knows business. Who do you think might lead this infrastructure bank, or who would you want to lead it?
That I don't know, but I think we do have not only an infrastructure gap, a financing gap, we also have a management gap, right? Because there are so many layers of government that are involved. I mean, think of it. 98% of infrastructure in this country is owned by the provinces and the municipalities, and yet most of the money comes from the central government. So there are very complex issues here of management. No one's going to put up huge amounts of money unless the governance structure is clear and has a fair amount of independence from the government, so that if you have change of government from one party to another, things aren't going to be upset. Like our great pension funds, they're managed at an arm's length distance from the government, and they have professional management. And what you have to do here in this infrastructure bank is have the best people in the world running it. No question about that. It has to be a center of excellence. And over time, it could play an international role, because now the government's decided finally that we'll join the Asian Infrastructure Investment Bank. And we could then link up with that and become involved in bigger projects. And through this huge investment, we're going to create Canadian companies of scale in infrastructure if we use procurement in a smart way. And that will then create companies that can play internationally in this field.
Jeffrey, let me get your take in terms of what you've heard from this announcement yesterday, having an infrastructure bank to the tune of $200 billion to really leapfrog, we hope, and jumpstart our economy.
I think your economy is going to pick up noticeably because of the price of crude oil. I mean, you've almost doubled the price of crude oil, and I was with T. Boone Pickens in Dallas this week, and he was suggesting a $60 price deck by the end of the year and an $80 price deck by next year. And I think that solves a lot of Canadian, slow economic growth. Also, since you were at Goldman Sachs, Gene Hazaras has put out an excellent report that talks about measured productivity and unmeasured productivity. And there's a lot of unmeasured productivity out there. Things are more productive than the surface figures suggest.
We have a similar view on oil. As you know, I'm looking for $75 by 2018-19. That doesn't solve all this country's problems by a long shot, right? Because when the dollar was very strong, it effectively destroyed the manufacturing base of central Canada. Over 10,000 companies disappeared, and they aren't being replaced. So there's a lot to do, and plus there's a whole new wave of technology coming that puts at risk a large number of jobs that exist in this country. 30 to 40% of the jobs that we have today will disappear 10 years from now and be replaced by other jobs. So higher oil prices will be good, but it's not going to be the panacea. And we don't want to be just an energy-driven economy. We want a more balanced economy. We want an economy more engaged in the world economy. And we don't want just to export raw materials. We want to transform them and capture some of that value added.
I get it.
Yeah. With respect to what Canadians, the average Canadian, can take away from this infrastructure bank, how will they be participating in this?
Well, as we go through, I think there should be a debate on that very question. If the infrastructure bank issues bonds and it's backed by great infrastructure, I'm sure many Canadian families will want to invest in it and own these bonds. So that's an opportunity that I would think we should be looking at.
Ken, do you think as well that there's going to be a lot of interest in private companies actually wanting to partner up? This is a public-private partnership essentially, and the government is looking for a 1-to-4 ratio, from what I understand. Is there a lot of interest?
Yeah, Catherine, in the private sector, and I run a private equity company and other finance companies, we're interested in the financial return. But infrastructure returns aren't just financial returns. They allow to increase productivity for the entire economy. They generate jobs. They generate tax revenue. They generate growth. So the way we have to look at return is much broader than a narrow-focused private sector investment. So my view is that the main equity in this bank will be provided by the public sector, and then the rest of the money that's raised will essentially be raised through the debt markets.
Okay.
That's how I would look at it.
Okay. What was it like in terms of having these discussions and coming up with this plan?
Well, there are some people who like to see it very big and dynamic and active and aggressive, and you can imagine who that is. And then there are some people who are, what we've been doing in the past is okay. But we have to break with the past. We're in an impasse now, and we have to move ahead. And I think this is a great decision.
Excellent. Ken, nice to be with you again. Thank you very much. I know it's been, I'm sure, very busy. Thank you.
Okay, folks, we'll go to the news, and when we come back, David Prince, who's the founder of Harbinger Capital Markets Research, and you won't want to miss his two-part interview with Michael Hainsworth of our affiliate BNN. Stay with us. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
The Canadian dollar has done a faceplant here going into the weekend amid lowered expectations for domestic growth. We had a pair of weak economic data points as well. For more on this and the state of the Canadian economy, Harbinger Capital Research's David Prince joins us now. Good to have you with us.
Nice to be here.
All right, let's start right off the top here. Canadian dollar got its head handed to it, courtesy of the Bank of Canada, saying we did have a conversation about cutting interest rates further.
It's pathetic that we have this gentleman that keeps on trying to make excuses for a wrong forecast, but this week he reached a new low as far as I'm concerned. The reason his forecast is all off is because he said the first half he didn't expect the American economy to be so weak. That's fine. And then he lowers everything from here on forward. So does he expect the U.S. economy to be that much weaker? So you sort of think, is there any policy that makes sense? Because clearly he's lost track of the old inflation target, which used to be Bank of Canada's central mandate.
Which sort of led to expectations or the belief by some that he was trying to talk down the Canadian dollar further.
For sure. And what does that do? That obviously raises inflation, but it's the wrong type of inflation, because what's happening is that we're losing our competitiveness, which he finally addressed in this monetary policy. The issue is we are competing against the Mexicans, and the Mexican peso has been falling much faster than what you've dealt with in terms of the Canadian dollar versus that of the U.S.
So our purchasing power is degraded, which means we have to pay more for our goods. That boosts our inflation. Yet at the same time, the hope, the expectation that was this time last year conversation was, by the time the Canadian dollar is 75 cents, our manufacturing sector will be on the rise.
Right. And as I said to you at the time, it's clear that they haven't got a clue about the changed world. So when you're only looking in isolation, which used to be the case that there was a bilateral trade only, that was a nice, convenient way to look at it. But a lot of, unfortunately, our politicians are looking at old textbooks, and the world has changed. And what's seemingly happening now is that, yes, here we had the oil price back up over $50. Lo and behold, the Canadian dollar falls. Well, what's being realized is that foreigners are realizing the weakness of the Canadian economy, and the fact is that there's going to be no alternative for the Bank of Canada. He's going to be forced into lowering rates, which will not kickstart the economy.
Right. We've already had that conversation. The law of diminishing returns is we're at 0.5%, near historic low. I was interested in getting your take on the impact that the new mortgage rules are going to have on Canada's GDP. I think they shaved 0.3 percentage points off by 2018, which is about a $4.8 billion hit to our economy.
Okay. And you say to yourself, again, this is expectation based upon prior knowledge. It's much the same as what they thought they could control the house of pricing. And we really don't know because there's so many secondary markets. I have no idea what the impact's going to be in terms of the tougher mortgage rules. But right now, it certainly seems that what we're dealing with has nothing to do with the mortgage rates. It has more to do with the costs of government, and the costs keep going up much higher as it relates to certainly. I'm glad to see that Ontarians are finally getting upset because they're seeing those electrical bills. That goes on top of a multitude of other bills that have been raised. So when the retail sales came in today, why should people be surprised? The going back to school period was very weak this year. People got hit with new rates in this province, I know, and certainly now there's talk about a higher cap and trade coming in January. That's going to really help the consumer.
So the expectation was that the federal government's child benefit tax
right
or
check
right. that came in would help goose the back to school sale.
Right.
And but so, you're telling me that the price I paid for electricity to just keep the lights on in my home ate up a lot of that?
A lot of that, and more importantly, don't forget wages have not caught up with government costs right across the board. So let's stop kidding ourselves. It's all part of this shell game that keeps going on. It's like Kathleen Wynne saying, well, look, I'm giving you that great discount back on the HST, which shouldn't have been in place to begin with, but I've more than doubled your electricity rates over the time that I've been in office, and you shouldn't really bother me about that. Well, the reality is that people are finding it tough, and you are seeing that this whole demand for taxation is starting to stifle the Canadian economy, especially when you're talking about restricting where the area of growth was, which was obviously in the energy field.
So the retail sales data August, the inflation data September.
Right.
So what can we derive from the inflation data that gives us a sense of the future based upon what we saw in August?
Well, the problem with the inflation data is it's going to be very skewed because of the Canadian dollar. So if it starts to drop again, it'll look like core inflation's going up. Again, though, that's not benefiting the average wage earner. He cannot keep up to any increase at this point. And this is what happens when you have had a diminishing real return on wages.
So this comes back to the whole issue that there's no value in the Bank of Canada cutting the overnight lending rate yet again because the monetary stimulus is not going to help. We need fiscal stimulus, but throwing more cash at our economy doesn't work either because that only works on a longer term basis. We need something now.
Well, the biggest problem has been that we've fixated upon all of this need for government help. That leads us into, well, here comes Bombardier. And so why didn't the stock get hammered today? Because it almost guaranteed that the federal government's going to throw more money. They've already wasted that $1 billion that the Quebec government's put in. So now we're going to still lose the jobs that we originally were supposed to protect. It's much the same as like Kathleen Wynne throwing the money at Cisco because I need these jobs. Well, those jobs were going to come to somewhat here, but if you have to go buy them, then there's something wrong with your overall system. And that's what's been happening, is that we're buying jobs, and that's only temporary.
So Mr. Morneau has been talking to some of the tall foreheads on Bay Street. 50% increase in skilled immigration. Infrastructure bank, $300 billion or so to attract the foreign capital. Does this help boost the economy in any way, shape, or form on that shorter-term basis that we need right now?
It does, and it's nice that they finally got around to something that makes a little more sense, but I'm sure it cost a lot in terms of all the hotel rooms. But the reality is, yes, put it into a smaller group that can act on it, therefore it makes it more efficient. The big problem with a lot of these programs is they're monstrous programs, and no one knows how we're going to get it down to the actual needed person. So right now, we're dealing with the reality of the honeymoon being over as far as the feds go. Now we've got to deal with what the reality is of the provinces, and the provinces are still hurting badly. And that, to me, is something that you just can't repair simply by fiscal stimulus. The reality is that you need to change your whole course and stop putting so much pressure on business to create new businesses, because right now we're not seeing that at all. In fact, we're going to lose more over the next 6 months.
Let's expand this conversation into global macro when we come back.
Sure.
All right. Super Mario Draghi going to continue throwing 80 billion euros a month at Europe's low growth problem. We'll get David Prince's take on that when we come back.
Now to part two with David Prince of Harbinger Capital Markets Research.
Harbinger's David Prince is with us as we look at the three things he'll be watching next week. Top of the pops, Caterpillar and all the other earnings players.
Yeah, there's no question that, as we saw this week, earnings had a big impact on the stocks immediately. We saw it with McDonald's going the way it did in terms of it was a surprise. We certainly saw the inverse of that with the case of GE. The GE one had a bigger weight on the market this morning because they were talking about their outlook being really much weakened than what they had talked about even a month ago. So what we've got to be watching, of course, as we go through earnings is their outlook. Earnings beat doesn't matter anymore. I mean, here's General Electric saying, well, we beat on earnings, but we're
buying back shares is what it is.
Exactly. $4 billion buyback. So what does it mean? What has to happen is top line growth still has to expand, and that's what people are not seeing as much as what they'd like.
How much of that is damaged from the strong U.S. dollar when they repatriate those foreign dollars?
That should be over. See, it's not, that impact on a year-over-year basis is not as big as what you think.
Okay.
The real issue is that they're getting slowing growth in the other areas. Oh, isn't that a surprise? We're getting slowing growth coming out of Europe.
And I guess CNRAil will give us some insight into not just Canada, but the United States. too.
See, that's next week. We're going to get a better idea. That CNN's a big one for Canadians to watch. That certainly will give a much better idea of what's going on in the economy. The rails have been really good, but the rails have been signifying that things are not so good. So let's see how we fared. What I would also say for a lot of the gold bugs, they're going to get a whole bunch of earnings next week. All the biggies are reporting. And even though they don't trade on earnings, what people are starting to do in the gold market is differentiate which ones they want to hold and who's in the best shape financially. Because we've certainly learned in the downturn, if you don't have a good financial balance sheet, you're going to be in trouble to get through lowering prices.
Economic data south of the border will help us out as well, not the least of which is the housing market.
This has been an ongoing issue with the United States. It's been a stop-start type of situation for the housing market. We need more sustainability in the housing market. We're going to get another bunch of news in terms of the housing sales next Friday. Certainly that will give us a better idea of exactly what's going on in that area, because if in fact we see continued weakness in the construction area, that's a big area of employment. That will raise a few eyebrows, to say the least, about what is going to happen in terms of rates and the overall U.S. economy.
And that could play into the University of Michigan Consumer Sentiment Surveys.
Well, that's already, exactly. We've already had the preliminary, and it was not very good. No. So I want to see what happens with the finalized. And the part that I guess that got me the most is watching the Canadian dollar this week was a really, really good indicator. And boy, here's what we're seeing. We're seeing a lowering of the Canadian dollar, seeing a lowering of the Aussie dollar, seeing a lowering of the New Zealand dollar. We're seeing the strength of the U.S. dollar overcome a lot of these different currencies. What's intriguing to me is the Canadian dollar now has fallen again below that of the Aussie dollar. So where are we back to? Aussie markets and New Zealand markets both have higher yields than what you get in Canada. If we continue to have this situation, then the Canadian dollar will in fact get hit more than those two other currencies, and also we'll ignore what's going on in the price of oil.
Oh, okay, so you think that even as oil looks like it's continuing to climb, we've got the rig counts on the rise in the United States and Canada, demand seems to be improving as we get out of that shoulder season. You think that's going to be overshadowed by the strength we're seeing in the U.S. dollar on the U.S. data?
That's right.
Okay.
And that's certainly going to have an impact on the Canadian dollar, but we're also coming into that horrible season, which is called the snowbirds, whereby we need a whole bunch of U.S. dollars. And so when you get into this seasonality, the point is that the dollar does have weakness over this period.
Snowbirds buying U.S. dollars actually moves the needle on the Canada-U.S. dollar exchange
rate? Well, it's certainly some of the influence.
Fascinating stuff. Good to have you with us. Thank you so much, David.
All right.
David Prince of Harbinger.
We will go to a break now, and when we come back, an excerpt from Eric Sprott's presentation to the Precious Metals Forum here in Ottawa on October the 5th, and you won't want to miss it. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
What do I want to start with? Well, first of all, I don't really have a canned speech for you, okay? So I could be rather dangerous. But I want to start off with just a data point. And the data point I want to start off with is the U.S. debt for the year ended September 30th, 2016 was just announced. And it went up by $1.4 trillion. $1.4 trillion. And yet the deficit estimate for the year ended September 30th, 2016 is $590 billion. Now, I want you to think about that. The government is telling you they're running a deficit of $590 billion, but the debt went up by $1.4 trillion. That's not easy to do. There's something missing in this equation, okay? We got $800 billion more of expenses that aren't somehow included in the deficit. That's the way it is. And that's what's on the books. Who knows? I mean, as John mentioned, you could be talking about Fannie Mae and Freddie Mac and student loans and this, that, and the other thing, and in fact the obligations are even more. One of the things that I like to have people think about is just how to think about things. Like, does it make any sense that the deficit was only $590 billion? It's impossible to imagine that, okay? Just as John has already pointed out, and one of my key cares is the whole unfunded liability situation in the States. I say there's three problems with the U.S. economy: healthcare, healthcare, and healthcare. It's unbelievable what you and I watch going on in the healthcare business in the United States. I mean, there are more articles about how much the Obamacare premiums are going up by this year, with people receiving their invoices, I think, in early November, for the subsequent year. And they're all double digits, of course. Some of them in the 20s and 30s and 40s and 50s. As you know, a great number of they call them co-ops that sprung up to provide Obamacare. Most of them have gone broke. There's very, very few remaining, which means that the likelihood of healthcare getting more expensive is going higher. One of the beauties of numbers is the mathematics of things. And when we were watching, for example, 30 and 40 years ago, that healthcare would go up, 5 and 7 and 10% a year, you knew, okay, well, you give me 50 years of that and I'll tell you 100% of GDP will be healthcare. It's just numbers, okay? And they keep going up at double digits. Healthcare is almost 20% of the budget today. People's expenses is 20% healthcare. Well, just try a 10% increase on a 20% of your budget. That's 2% inflation right there. And by the way, speaking of inflation, there's an index in the U.S. called the Chapwood Index. And they measure, I think it's something like 500 articles, things, services that people buy in cities. And it's been going up at, I think the number is something like 7 to 10% a year every year. Yet inflation is stated to be less than 2%. In fact, we want it to be 2%. I'm the head of the Fed and I want inflation to be 2%. It just sounds so friggin' hollow to me, because we're already way past 2%. Look at the rent increases. Look at the health care, the cost of education. These things are all blowing out here. Inflation is massively understated. And I could go into, the guys behind the curtain just keep giving us lousy data that we shouldn't believe, that you should not believe the data. Let your own mind and your own experience tell you what should be going on, or what is going on. There was a great question asked: when do people lose confidence in the central planners? Or the question might have been, when do the central planners realize that the gig is up? And I'm taken back to a couple of weeks ago now, maybe 3, when Mr. Kuroda of the Bank of Japan came out and talked about the fact that he's hearing from corporations that low long-term interest rates make their provisioning for pension funding skyrocket. That's what happens, right? You got a pension obligation, you got no return, you have no prospect of a return. How do you have enough money in your pension fund to provide for this? And therefore your contribution has to go up. So Mr. Kuroda gets the knock on the door. By now the corporations saying, Mr. Kuroda, you're counting us. And he's already been getting the knock on the door from the banks who say, you're killing us. The pension funds, you're killing us. The savers, you're killing us. And he finally says, maybe we should have the long rates go higher. That's what he said, so that somehow they won't have to take these provisions on their books. And of course, that's when the yen rallies. The rates shot up around the world. Contagion. Somebody asked a question about contagion. Believe me, there's contagion. Rates went up in every country.
If you would like to listen to Eric's complete presentation and also John Embry's presentation at the Precious Metals Forum, just go to johnbudden.com. Well, that's it for Money Talk, and I hope you have a good week. We'll be back next Sunday, 2 p.m., and the goal of this program is to provide you with relevant stories from the week and hopefully insights that will help you with your portfolio. I'm John Budden. Thank you for joining us. You are listening to 580 CFRA.